In this video, I will show you 5 best moving average strategies for scalping day trading or swing trading. Moving average involves moving average rebounds, Guppy multiple moving average crossovers, and 3MA pullback strategies. Before we get into the strategies, there are few things you should understand about moving average. A moving average is simply a method of smoothing out price movement to assist you differentiating between typical market noise and the actual trend direction. In other words, a 200 moving average is calculated by taking the average closing price of currency pair and over the last 200 period and dividing it by 200. Trends do not follow a straight line because price moves randomly. A moving average smooths out the random price movement and helps you in determining the trend direction. You probably know that there are two major types of moving average: simple moving average and exponential moving average. But when should you use simple moving average and exponential moving average? Which one is better? The exponential moving average is generally thought to be better situated for short-term trading. It is appropriate for scalper and day traders because short period EMA react to price movement relatively quickly. This can assist you in detecting trend very early, resulting in higher profit. In fact, the sooner you recognize a trend, the longer you can ride it and cash more pips. When I want to smoother and slower moving average to respond to price action, I use simple moving average. This is useful when looking at longer time frame because it can give you an idea of the overall trend. Don't use SMA with lower time frame because it is slow to respond to price action. It may save you from many fake outs and you may miss out a good entry price. Remember that moving averages do not predict future price direction, rather they define the current direction with a lag. The purpose of using moving average is differently trend sense. However, they can generate a larger number of false signal. For example, pound dollar is a moving upward and closing above. A moving average indicated an entry to go long, but you still don't know whether the trend will be bullish or fell down. Moving average involves can be useful in this situation. A moving average involve is made up of a moving average and two additional lines. The term involves refer to how these two lines encircle the original moving average line. Moving average involves can be used in two ways. It can be used to confirm the trend direction and determine whether a market is overbought or oversold level in sideways market. How to confirm trend direction with moving average involves when the price moves above the envelopes, this is recognized as a bullish trend. When the price moves below the envelopes, this is recognized as a bearish trend. The price is neither in a the price is neither in an uptrend nor a downtrend. When the envelope moves sideways, the price is considered to be directionless because the trend is neutral. How is the envelope breakout stage 2 by signal? 10 is frequency begin with a strong momentum. Notice how the 20 period simple moving average as well as the upper and lower envelopes are going up. You could wait until the price close above the upper envelopes to confirm that the trend has changed from bearish to bullish. The 20 period moving average and envelopes are failing. You must wait for the price to close below the envelopes to confirm that the trend has changed and the trend is moving down. How to identify overbought and oversold level with moving average involves when the market goes sideways, the price will break even with the envelopes and always return to the inside. When the price goes up above the upper envelopes, it said be overbought. When the price moves below the lower envelope, this can considered oversold. But remember that when the bullish trend is strong, currency pair can become and remain overbought. The same can be said by being oversold in a strong bearish trend. It can be technical oversold but remain so for an extended period of time. Check this slope of the moving average to ensure it is a flat. This chart is going sideways. There is neither a strong bullish or nor strong bearish trend. Take note of how the upper and lower impulse perform as a strong resistance level. Whenever the price was trading near the upper or lower impulse, it bounce back. Those are overbought and oversold areas. When the market goes sideways, we use impulse, overbought and oversold level to decide whether buy or sell. If the price touches or falls below the lower impulse and then rise above, it indicates a bullish signal. If the price touches or goes up above the upper impulse and then come back below, it is indicate a bearish signal. A moving average ribbon is a chart that display a series of moving averages of different lengths. Normally I use 5 to 15 moving averages to determine the extent of 10, which give you better idea than 1 or 2 moving averages. You can use a 5 to 16 simple moving averages set at 10 period intervals such as 10, 20, 30, 40, 50, and 16 simple moving averages. Moving average with more periods such as 200 are less sensitive and smoother for shorter time frames. You can use exponential moving average instead of simple moving average. How to trade with moving average ribbons? Moving average ribbons can be traded in three ways. One, an expanding moving average ribbon. Two, a contracting moving average ribbon, and the third is a parallel moving average ribbon. When the moving average begin to widen and separate, it indicates the recent price direction has reached a maximum level and may signal the
guides us in identifying the end of a trend and looking for a trend reversal.
And looking for trend reversal.
A contracting moving average ribbon indicates a possible trend change. When the moving averages begin
between the converge and get closer to each other, it is possible the trend change has begun. This happens after the ribbon expansion. Shorter term moving average will converge. First long term moving average will gradually converge. After the price break the last moving average, it will return and reset a few moving average before continuing the trend. Here you can put a buy order. You can exit the trade when the ribbon is expanding. The same goes with bearish contracting moving average ribbon. After the price breakdown, candlestick will reset a few moving average. You can place a sell trade. Here you can exit the trade when the ribbon is expanding. Guppy multiple moving average is a trend following indicator developed by an Australian trader. Their Guppy multiple moving average is used to spot trend and reversal. It gives you an objective way to know when to enter and when to exit the trade. The Guppy indicator is divided into two groups: 6 short-term exponential moving average and 6 long-term exponential moving average. The 3, 5, 8, 10, 12 and 15 exponential moving average are used to indicate short term in trend. The 30, 35, 40, 45, 50 and 60 exponential moving average indicate the momentum of the longer term trend. These two groups of exponential moving average can be used to identify trend reversal and continuous Guppy. Continuation. Guppy not only shows trend direction and reversal but also trends momentum. The Guppy indicator can be used in three ways: identify trend extent, identify trend reversal, and identify consideration period of trend. How to identify trend extent with Guppy? The distance between the short and long term moving average can be used to gauge trend strength. If there is a wide separation, it indicates that the current trend is strong. A narrow separation or intertwined lines indicated a weakening trend or a period of consideration. How to identify trend reversal with Guppy? Trend reversal are represented by the crossover of the short and long term moving average. A bullish crossover occurs when the short term exponential moving average cross above the long term moving average, indicated a bullish reversal. A bearish crossover occurs when the short term exponential moving average cross below the longer term exponential moving average, indicated that a bearish reversal is taking place. How to identify consideration with Guppy? When the moving average of the two groups are close together and nearly parallel, it indicates that the short term market sentiment and long term trend are mostly in alignment. When both group of exponential moving averages are moving horizontally, mostly sideways and heavily intertwined, it indicates that the price lacks a trend. As a trend trader, when the market is choppy, you should avoid and wait for better condition. How to use Gappy multiple moving average is trading? There are two methods for obtaining signal using the Gappy indicator: Gappy breakout strategies and Gappy composition breakout strategy. When all of the short-term exponential moving averages cross above all of the long-term moving averages, a new bullish trend is confirmed. The short-term moving average pull back to the longer-term moving average but should not cross. When the price cross above the short-term exponential moving average, you can put the buy order. When all of the short-term moving average cross below all of the long-term moving average, a bearish trend is confirmed. The short-term moving average pull back to the longer-term moving average but should not cross. When the price crosses below the short-term exponential moving average, you can put the sell order here. Gappy compression breakout strategy moving average also help as a level of support and resistance. When both of group of moving averages compare on the same candlestick, it may indicate a change in the overall trend. By order, both group of EMA have become tightly compressed. Take note of how to last candle open below all the moving averages but close above all the moving averages. Set a buy stop order above the candlestick high and sell stop order below the candlestick low. The price rise in the next candle triggered the buy stop order. Previous sell stop order has now been converted into your initial stop loss. If the next candle close below the sell stop will trigger when the two different moving average line cross over one another. This is referred as a moving average crossover. If the moving average cross, it may indicate that the trend is about changing, giving you the opportunity to get a better entry. This is a pound dollar daily chart. The pair was in a nice uptrend from around September to October. The 10 simple moving average has crossed below the 20 simple moving average. Downtrend has begun. You could have made nearly 1,000 pips if you had shorted at the crossover of the moving average. When the 21 EMA cross above the 50 EMA, it's time to look for a pullback to the 21 EMA. You can place a buy trade here. When the green candle closes, stop loss is below the 50 EMA. When the 21 EMA cross below the 50 EMA, it is time to take for a pullback to the 21 EMA. You can place a sell trade here. When the red candle close, set stop loss above the 50 EMA. I have added 50, 100 and 150 period exponential moving average. The 50 period EMA give me the short term trend, and the 100 and 115 period EMA give me the medium and long term trends, depending on the type of setup you looking for and the time frames you are trading. You can use any number of period combination. Looking back at this chart, notice how price push above the 3 moving average and all 3 EMA are moving into parallel. This trend is very bullish. Price eventually fell below the 15 period exponential moving average, indicates short term weakness. However, a bounce back on the 100 EMA confirms that the medium and long term support level are strong. Price should not close below the 100 EMA. You can put a buy order when the price break up with momentum. Stop loss set below the 100 EMA or 115 EMA, depending on your trade setup and risk and reward ratio. Price should below the 3 exponential moving average. All 3 moving averages are moving in parallel. This trend is very bearish. Price eventually break above the 15 period EMA, indicates short term weakness. However, a bounce back on the 100 EMA confirms that the medium and long term is support level are strong. Price should not close above the 100 EMA. You can put a sell order when the down with momentum. Stop loss set above the 100 EMA or 115 EMA moving average act as dynamic support and resistance level. It is dynamic support and resistance because this is not your typical horizontal support and resistance line. They are constantly changing based on recent price movement. Examine the chart. I have included a 100 period exponential moving average. When the price approached and tested 100 EMA, it act as a resistance and the price bounce back up. This means that the price will not always perfectly bounce off the moving average. It will occasionally go slightly past it before returning the trend's direction. However, you should be aware that they, like any other support resistance level, can break. You can see that the 100 EMA act as a strong resistance level for a while with the price representative brought up it. However, the price eventually broke through and went up. Price then reached and tested 100-day exponential moving average, which provide to be strong support level. Risk management is important. Use less than 5% of your account balance for a single trade. Another thing to remember is not over trade. If you lose 2 or 3 trade in a row, close the trade and take a break. Thank you for watching.